Well, good afternoon, everybody. My name is Andrew Freeman, and on behalf of our commercial specialists throughout Australia and New Zealand, I'd like to thank you all for joining us here today as we explore the values of commercial property in the pandemic. Now, real estate has certainly gained a lot of attention over the past 18 months, and has continued, as we see continued residential values booming across almost every single market, and reports of buying across asset classes, again, buying sight unseen. So there's quite a few abnormalities in the marketplace. But with all this activity, coupled with the global pandemic and markets going in and out of lockdown, how have commercial property values been impacted? And looking forward, how are the banks reacting to these conditions? So today, to take us through these questions and more, of course, we have like to welcome Dan White, our Managing Director of Ray White, and of course, Robert Wilson, Managing Director of Ray White Valuations. Now, if you have any questions during the course of today's webinar, please type them into the into the chat function there at the bottom of your screen. Or of course, please feel free to reach out to your commercial specialist. They'll only be too happy to assist you with any questions that you may have, whether it be asset specific or your personal situation. With that said, thank you again. I'll hand over to Dan and Robert.
Thanks, Andrew. Great to be with everyone. Thanks so much for joining us. Been looking forward to this discussion, Rob. Now back in the office a bit together, seeing each other a bit over the course of this week to talk about this important topic around valuing commercial property in a pandemic. Lots to discuss in our half hour. We're going to go through a whole range of things. But before we do that, Rob, just a bit of background for the guys about yourself, Managing Director and Partner of Ray White Valuations. Can you give the audience a bit of an overview of your business and your career in the industry?
Sure, Dan. So Ray White Valuations, we've been in business for almost 12 years now, and we've got a staff of 20 commercial valuers, professional valuers across all the different asset classes in Sydney and Melbourne and in Wollongong. And we've got a team that specialises in what they do, so they're not wearing all different hats. What they do is what they do every day of the week. So they're well respected. We're on almost all the major bank panels and other smaller banks as well as other non-bank lenders and the like.
So today we're going to talk about values, obviously, but also valuations, and the important difference. We've got obviously on one hand where we've got property values, and everyone knows and reads about what's been happening with values. It's obviously different across different asset classes, but generally speaking, values is talked a lot. We'll talk a little bit more today about valuations and the whole process of putting a professional investment thesis around an asset to determine its value, where you've got discounted cash flows, you've got assumptions to make, you've got to look forward, you've got to have discounted cash flow rates, you've got terminal yields, all these things that go into the figures. And within a pandemic, how do you sort of arrive at those numbers? And so as we go through the discussion today, we'll be coming back to that a few times, and just show all our customers and clients, and indeed our members in the Ray White Commercial Group, have that perspective from people are looking to trade what prices are happening in the market, but how's that going to stack up in a valuation format? What are banks going to say about it? Does it comply with bank standards? All those sort of factors which we'll touch on today. Before we start, Rob, can you rank from 1 to 10, on a scale of 1 to 10, how would you rate the level of activity at the moment in the valuation industry?
Dan, that's a good question. We've the last 9 months has been very, very busy. So I think we're probably at a 7.5, 8 in terms of how busy we are. We haven't been this busy this early in the financial year, as an example, for a long, long time. So,
and then on the other hand, ranking from 1 to 10, the level of difficulty being a valuer, sort of looking at the numbers, sort of. You've got a customer or bank wanting something valued, you're getting into it, rank of 1 to 10, how's the level of difficulty in working through the numbers and coming up with figures that make sense?
That's an interesting one, Dan. I think it depends on what and where it is. So being on the asset class and location and things like lease covenants and all that kind of stuff. But the harder stuff at the moment is the retail stuff. Probably industrial is probably the easiest at the moment. That's probably the strongest space in the market, and res dev is very strong. So I think we're probably around a 6, 5.5, 6.
So let's start off with talking a bit about valuing in a pandemic in sense of the framework. What approach the banks took with values when in sort of last, say, April, May, when there's so much uncertainty what was going to happen with the pandemic, what was happening with the bank's approach to valuations? Did they want valuations done? Was there standards applied? How did the industry react?
The industry reacted in different ways, Dan. APRA gave the banks permission to hold over any renewals that were coming up in regards to valuation. So they had a holiday period up until March this year. So it was very quiet over the last, so from prior to March, it was very, very busy, quiet. And then it got busier as those renewals came back and the banks had to start reporting to APRA. So the banks report generally on a monthly basis to APRA about their risk by asset class. So the valuation process is very important to them, and having to report that to APRA. So that's sort of something that's come in the last sort of 5 to 6 years, and APRA is becoming more and more on top of the banks regarding that the process and also their risk appetite and profiles.
What about there's an API standard, a pandemic sort of?
Yeah, there's a valuation uncertainty standard. Yep. So
explain that one.
So that's all that is really just saying that the market, the property or assets in at the moment or at this point in time is being impacted by uncertainty within the market or within its particular market or asset class. So it's just something for the banks to putting on notice with the banks and our clients that there's we're valuing in a very uncertain time, and anything can change. We've seen over the last 12, 18 months, we've been in and out of lockdown, back in lockdown, out of lockdown again. So those kind of things are going to affect assets as they move through those cycles.
Is there any sense how long that will stay in place for, that sort of overall framework?
No, I don't think I think it'll be at least another 6 months. So maybe early next year might start seeing the discussions around that being lifted. Interestingly, some of the banks, when we were back out of lockdown, the banks were saying, do we really need this? Or some questions asked. But I think as a whole, the industry's wanted to keep that in there for the short term at least.
Yeah,
anyway.
It'd be interesting if that does get lifted, what happens. I suppose will depend on the market, no doubt. But that is something there that's probably it's taken some of the pressure off, I suppose, in a way of how things work.
Yeah, although I don't think so, Dan. I think we like to try and get it right when we can. I think the hardest thing at the moment is trying to work out, particularly on the retail side where rents are. Obviously, income on those businesses have been terribly affected. So there's been a lot of discussions around how we defer rental or income on our valuation capitalisation approaches. So obviously, depending on the business and where it is, we're doing an abatement of 3 to 6, 9 months sometimes. So it just depends on what it is.
Where it is. Okay, let's go through the different asset classes. We're going to go through the asset classes. We're going to talk about what's driven values over the past year or two, and how values reached this point so far. And then we're going to, on each asset class, let's talk about what are the risk factors people identify, what are the areas, what are the risk or what are the areas of uncertainty that really are important in a valuation process, or big assumptions need to be made at the moment. And then finally, sort of, over the medium to long term, what are some key things for us to look out for? So let's touch on those 3 topics. And again, any questions you guys have, please, we've got one here at the moment we'll come back to a bit later, but any questions, please shoot them online around any particular asset class. We're going to start with industrial. Obviously now the industry darling, industrial values and what's happened there. Let's talk about that from both, maybe starting with Sydney, more broadly as well. What's happening there in the industrial sector and what's driven it? And what are some of the issues that the valuation industry is looking closely at? Sure, Dan.
So prior to the COVID, so industrial property has actually been the best performer through COVID. But prior to COVID, it was already very strong. Traditionally, it's probably the best asset class in terms of the 3 sort of major commercial asset classes. But driving that pre-COVID demand was a constrained supply of land in Sydney. We're seeing a lot of the land around Port Botany and Mascot being re-gentrified into rezoned residential development land. So with the view, the government's trying to push that land out to middle and western Sydney. So looking around the Aerotropolis as the long-term future for a lot of this, particularly the international kind of trade and supply lines. So that's been underlying there for some time, but obviously with COVID and the lockdowns and people being unable to go to the shops and buy things, that buying online and that e-commerce is just, in the last 18 months, has just absolutely driven that even further. So it is an interesting class. That there's a single or very few tenants within a complex or a building. There's been minimal COVID rental abatements over the last 18 months regarding industrial property, as opposed to, say, retail, which has probably had the most significant. So it's just it's been the darling of the last 9, 12, 18 months.
And what do you think in terms of industrial? It's obviously got a lot to it. A lot of things happening. A lot of sheds are becoming far more technology enabled. There's so many different aspects to industrial. Are we seeing that those sort of assets, those new age industrial properties, achieving big premiums to the more secondary ones, or is that an issue for some of the older stock? There's new stock coming through.
Look, it is, Dan. I mean, high clearance versus low clearance, all those kind of things. The technology to rack and stack, and obviously access in and out for big trucks and those kind of things make a difference. So a modern facility versus an old 20-year facility. Not that industrial changes a lot, but the uses and particularly the larger supply chains now, it's becoming more and more of a
with Sydney, you talk about the 3 different parts of Sydney as well. Let's maybe touch on that and how that affects industrial.
So that's right. So what we're seeing, as we said, we've got the Planning Commission. We've got the Eastern Sydney, which is traditionally Port Botany and around the airport. Then we've got the Middle Sydney, which is the Parramatta centric, and then obviously Western Sydney now with the Aerotropolis. So the government's long-term vision, I think, is to get more and more obviously out around the Aerotropolis and re-gentrify areas, say, like Port Botany. And the Middle Sydney is going to be interesting. It's going to be more mixed, I suspect, where obviously Western Sydney will be larger, big boxy formats, more suited to that international kind of supply.
It always takes longer. Delivering all that infrastructure for the Aerotropolis always takes a bit longer than people think, hence causing this sort of supply issues driving price.
Absolutely.
Beyond Sydney, let's talk regions, New South Wales and other cities, just to touch on that. Obviously, Wollongong and Newcastle.
Yeah, so I mean, look, everything at the moment's going really well. Wollongong, obviously, these supply chains need to have distribution centres around major hubs and long major motorways and things. So Newcastle, Wollongong are part of that, particularly Newcastle, and obviously Geelong and further on. So it's across the eastern seaboard, really national.
Yeah. Let's go on to. There's a great question there from Stephen around rates. I think we should just let's cover the other classes first before we come back. It obviously covers them all. Where obviously discount rates being applied.
Yeah.
We'll talk about inflationary risk, especially around construction things in a moment. Let's just jump on to office. Obviously, office market's been obviously fascinating. We're all no doubt all working in offices in some degree and look at this area closely for our own businesses, colleagues, as well as the broader market. What is the approach currently being taken, or what do you think is a sensible approach to factoring in pandemic risk in office valuations?
So I think this is probably the most interesting one, as you've said, Dan. So we're obviously the CBD has probably been hit the hardest. We're seeing incentives up to sort of 30+% at the moment
in Sydney.
CBD. I think we're going to see obviously there's rental abatements caught up in all that when we're valuing something, which is interesting. But I think we're going to see smaller, lettable area, smaller formats, more regional, perhaps. Maybe instead of having an office in town, there might be some orbital offices around Sydney Metro or Melbourne, or so people can. There's a shorter distance to travel. Those kind of things. I think that COVID's taught us a new way of looking at things. These sort of things always do create people to reinvent things and themselves as well. So I think we're going to see a bit of a change in how office, particularly CBD office, is used.
But at the moment, value is not so much changing at the end. The prices, obviously, prices being achieved are high.
Volumes are low still. So it's very hard from a valuation perspective to see the depth of the market and volume.
Especially in leasing as well as sales.
Absolutely, leasing and sales. So market evidence as well. So that's probably the hard one as a valuer, looking at where we're going, particularly in the office, CBD particularly. Regional offices are doing reasonably well. St Leonard's, Chatswood to a lesser degree in terms of, say, the CBD as an example.
We're talking about Brisbane as well, even though it's obviously been largely COVID-free occupancy in Brisbane in terms of not leased occupancy, but people actually visiting the office is down to 20-30% of what it was pre-COVID. So there's obviously some concerns in markets that aren't affected by COVID. And if you compare that, then think about broader markets like Melbourne and Sydney, we've had more COVID impact. The next 6 months is going to be fascinating.
I think so. It'll be very interesting to see how that plays out.
There's certainly, in terms of like leasing activity, you're seeing, I mean, speaking with, our leasing team, I sent around a note yesterday, there's a lot of deals, a lot of them smaller deals though, aren't they, being done?
Yeah, they are. Yeah. So we've been seeing that, and that was, we were seeing a lot more activity sort of 4, 5, 6 weeks ago. I think it's slowed up a little bit. Yeah. Again, I think people are a bit tentative about how this, getting back to opening up again, how that's going to play in, and getting their staff back in. I think that until people are comfortable coming back into, say, the CBD, that's going to be interesting to see how that plays out. And also the medical side of it, that the government controlling all, government orders about how we live and work as well.
Yeah, varies from state to state.
Yeah, well.
Okay, let's touch on, let's go to retail then. Obviously, another big part of the market, which has been discretionary retail, especially being hard hit.
Yeah, so this is probably the hardest hit asset class over the last 18 months. They've been hit, high vacancy rates, decreased rentals, really high incentives, increase in letting up periods. So this has been really affected, and really we still don't know how this is going to play out. I think, as we said earlier, people have realised that they can shop online now. So how that plays into this retail side, obviously the CBD retail market's been absolutely hammered, where more neighbourhood centres and things have become a lot stronger, and most people visiting their local cafe shop and pizzas and local takeaways. So there's going to be a bit of a shift, I think, in how that sort of people perceive those investment types, as opposed to, say, CBD.
What about, on that point, obviously discretionary and non-discretionary retail, big difference. Non-discretionary retail remains solid across the board in terms of its, its valuation status.
Absolutely, and even was pre-COVID. So all those centres that had a predominantly food-based mix of tenants were outperforming those which were at a higher retail base. So we were seeing that coming through
and the whole growth of Uber Eats and everything else probably hasn't been a bad thing for some of those.
I think it's kept a lot of those businesses going.
So in a way, it's worked out okay. We'll talk a bit about residential development sites, other probably big asset class before we go to regions. Let's talk about resi development sites. Probably, it's been a really strong 6 months, hasn't it?
It's been huge. Yeah. It's. I think that obviously, we had to reinvent ourselves during the pandemic, when we were losing all those overseas students, and those things. The market hit a bit of a wall with pre-sales and the larger types of projects that are out there. But development's demand for sites in city, metro and regional areas has been incredibly strong the last 12 months. Dan, as you said, there's a low supply of sites on the market at the moment, which I think is helping underpin those sales and those prices. But also there's strong sale rates around subdivision, and the prestige market's been very strong. And the first home buyers market particularly, and there's also increases in sales of apartments. I think on the back of the price gap that we've been seeing in houses in Sydney particularly, it's all about affordability, and I think that market, people have lost some of that opportunity to get into a house market, but they can still get into a unit.
Yeah, I mean, it's interesting how much that's caught up, hasn't it? The established market really have overtaken new in a lot of markets, even in some of the more expensive Sydney markets, let alone Brisbane and Melbourne as well. To construction price, a lot of discussion around construction price. How's that factoring into site values? Has that come through yet, or is that still to come? Do you think? There's no doubt that there's a lot of talk around construction pricing going up, obviously materials and labour, and a shortage of labour generally.
Absolutely.
What are the risks there for that in the valuation side?
So we're seeing definitely increases in costs like trusses, framing, concrete, labour as well. So it obviously, if you lock in a contract over the construction period, you're probably okay, but it's going to get tougher to price things up going forward, and being caught out on pricing for projects is no doubt. But I think we're seeing 15-20% increases in some products and also the supply chain, things coming off boats from around the world, from China. Factories in China have been shut down or have been for up until recently. So getting those things can sit on docks for a long time before they hit the site. So that's all holding costs that are going to hurt. So it affects on the contract side of pricing something up, but then there's all those holding costs, delays that might happen through the project.
Yeah, it's a really interesting space. Regions versus cities. Obviously, we've seen the regions right across Australia really have a very strong run. How is the sustainability of regions? Obviously, the big question, isn't it? That a lot of people discuss. How do we look at that from a valuation perspective, and banks look at that? We've had regions enjoying spectacular sort of visitation from local tourism in certain markets. Where do we, as we're looking at even 3 to 5 years in our cash flows, how do we be sensible around that? Around what it might be. I mean,
well, that's a great, it's a great topic. So a great debate at the moment for us as valuers. So we're doing a lot of regional valuations where we're seeing, particularly accommodation and pubs and those kind of things where, because of the restrictions and travel, people are going locally or regionally. So we're seeing properties that are trading, 1.5, 2 times over their pre-COVID trading figures. So how do we look at that? How do we put that into our cash flows going forward? We've got to go back and look at what things were at pre-COVID, I think, and have a look at that as an idea. But I think going forward, there's going to be a lot of people traveling, so that even pre-COVID numbers may not actually be enough because of people wanting to go and travel and go overseas and do things differently. So that has been a difficult process and a thought process that we need to have in our valuations.
I suppose, and part of that is what are the plans of those new owners doing with those assets to maintain income or reinvest in the asset?
Yeah.
Okay. Obviously, we've talked a lot about the growth and different assets, the issues being identified, whether it be vacancy risk in office or regional income and that sort of thing. Obviously, low interest rates has been the anchor, has supported all these values, as it pointed out there, Stephen, in his question. And while there's so much uncertainty in the market, there's very low returns in cash and everything else. So people are putting faith in bricks and mortar, even knowing there are uncertainties maybe in the cash flow, but there is inherent value given the cost of funds, given low interest rates and availability of credit. Again, back to the question, Stephen, what's the approach in terms of allowances for future interest rate rises, or how are you allowing factoring that in? What's expected by banks in terms of you guys putting valuations forward? What's this general approach or assumptions regarding rates? Is just a buffer on the current rate that's applied generally on a DCF?
Yeah, so we tend to look at what the market, where interest rates are within the market, and that's the risk-free rate plus a buffer, but also looking at where lenders are in the market. So we've got the non-bank lenders obviously at a higher rate versus the banks at the lower end. So we try and, in our cash flows, particularly in development cash flows, which is my specialisation, we tend to sort of sit in the middle. We're doing a market valuation, so we don't tailor a DCF specifically to an individual's credit offer they might have from the bank. We look at what the market does and where the market should sit, and we use those numbers in our cash flows as an indication.
And have they been, in recent times, they've been rising steady the last year or so?
We've been pretty steady on them for the last 12, 18 months, probably 2 years or so.
And what do you look for in those change? What's generally the triggers for those numbers to change? Maybe increasing or?
Probably where the lenders are looking, where the lenders are seeing interest rates. Obviously, you've got to go out to the market to get a bank loan. So we look at, that's probably the most, realistic, I think, in terms of space. We can always add a buffer over a risk-free rate, but that sometimes, that might be a bit lower in terms of a market interest rate. And
on that point, to the question there, how in your career experience and stuff, what are the things the banks generally do in regards to dealing or working with the industry around valuations, what to allow for, and is it a consultation process? Does it sort of, do the banks start to talk to the industry about what they want to see in vals, or how does that sort of
not
work?
Really. I mean, the banks say you're providing us a market valuation, so you're the valuer. You go out, you determine what the market looks like and report that to us in your report. Banks don't want to be seen to be influencing. I know some people say they do, but look, on the whole, from my experience, they let you as the valuer tell them how you're seeing it.
Okay. Let's any sort of slight change of gears. Anything? There's a question here around valuing leasehold versus freehold. Do you want to jump on that one?
How long have you got? Yeah, look, that's an interesting question. Obviously, it depends on the term, all those kind of things. 99 years is basically freehold as an example. So there's often an increased a higher rate for leasehold, but it depends on the term and those kind of things.
Yeah, and the review structures obviously.
And reviews, all that kind of stuff. The covenant, all that. It's a long question. Yeah, long answer.
Long answer to a short question. Yeah, but there's so much nuance in the details of the lease, isn't it? That goes that drives a huge part of the value. Talk about working with just a chance to talk to some of our customers around what helps us provide best service to our customers and agents with instructing valuers. What are some ideas around ensuring that that things are done effectively, in a timely fashion? And what are some of those?
That's a great question, Dan. Yeah. So I think that it's for us. We need all that relevant information. The sooner we get it, the sooner we can get onto it. Leases, all the DAs, documentation, all that. Construction costs. Yeah, all those kind of things, obviously specifically relating to what the asset is, but that's probably the most important part, is getting information. So often we have to wait weeks or 2 or 3 weeks go by before we get drip fed and it comes out. So, and I say to my team, I'd rather you guys just get the information and then pick it up and do the job. Don't jump in, keep up. You just lose momentum and your head's not in it.
What's happening? Question about fees, valuation costs. What's the basis of it?
Well, that's
obviously quality charges a premium. Being
absolutely
being the service, but seriously, what's the general process? Obviously maybe pick a few different asset classes and how it works.
Look, that's an interesting one. Fees. I don't think fees have really gone anywhere over the last 5 or 6 years. To be honest, we're starting to see an increase in valuation fees at the moment. There's been a lot of rising costs that people don't hear and hear about with valuers. I mean, PI insurance is one major one. PI in the last 12 months has been significantly increased due to COVID as a start. A lot of insurers have withdrawn from the market in Australia, so there's been very few. That pool of insurers has got less, so they're charging more. So they're the kind of things that go in, the hidden costs behind valuations. But look, it depends on what it is, what asset it is. I know, the banks have got the what we call tick and flick valuers who go out there and just do a 2 or 3 page report. Our reports are 20 and 30 and 50 pages long, so it's a different cost.
Quick question on terminal. What are you doing at terminal yields, exit yields? Generally, it's still just a premium.
It's a premium. It's a couple points above where we see the market rate.
Yeah, and that's always, regardless, that difference is pretty consistent over.
It is generally. It's normally 2 to 3 over the current market rate. Yeah, depending on what it is.
Of course, yeah. And what risk level might be down the track. That's what's happening with the asset at that time. A question around valuing multiple tenancies in a single development with less concentration risk than single tenancy with high concentration risk. Obviously the process in that come down to, I suppose, covenant to a large degree.
Absolutely, and also timing. So when those expiries happen, and how sticky those tenants are. So are they going to renew? Is it a 50%, 75%? A chance of them renewing. So all those kind of things, having a good mix is important.
Yeah, I suppose understanding each market. What is the optimum size tenancy as well? How deep's the market for each of those categories?
Sure. And again, having grease traps, being able to be flexible within your space that you're offering. You can, is suitable for food? Is it not? Those kind of things make it. That flexibility is really important.
Some of the owners too, isn't it? That some like to be active owners, that they can like multiple, effectively multiple customers. You can expand space for some, contract and things, but other people don't want that level of management, prefer maybe a single tenancy or whatever. How that relates to value.
But obviously, risk, single tenant, if it's a a short-term lease expiry, you know, that's going to affect obviously value, because you know, we don't know what beyond that period something might.
I think the question was around industrial too, which is generally, you know, especially at the moment, certainly an area where probably to be more comfortable with expiry risk than a lot of other sectors.
For sure. Yeah, and I think we're seeing rents starting to slowly increase in that space as well. So it's a good space at the moment.
Yeah. There's a question that's specifically around. I was going to have a crack at that around high clearance warehouses in Botany. Small ones under 100 square metres. The future of them. Pretty hard to, you'd be pretty hard to bet against Port Botany Industrial at the moment, wouldn't it?
I think so. I know of a number of obviously probably strata, I suspect, being that small. I know a lot of strata developments out there that are being bought out by developers, and it's being rezoned, and you know, resi developers are buying it and paying good money for them. So you're always going to have the small tradies and businesses that need that kind of space. So I think it's you know, up and down around Australia. I mean, up Northern Beaches and you know, Mona Vale, you know, Brookvale, then out around Parramatta and those places. It's yeah.
But if you'd like to maybe sell the asset, we could have a few agents we know could do the job there. But we're probably out of time now. Thanks for all your questions. We really appreciate the chance to talk to you. Thanks so much for joining. I mean, obviously, the family, we're super proud of Rob and his team and the Robot Valuations. They do a fantastic job. I know a lot of their clients personally, and obviously banks as well. So very fortunate that Rob and his team is part of the group, and hopefully sharing some of his expertise today was of value to everyone that joined us. Anyway, all the best, and any more questions, of course, we'd reply to you in due course. Thanks, Andrew. Over to you, mate.
Thanks, Dan.
I think we're absolutely well said, Dan. Thank you for your thanks for your insights there, and again, thank you everyone for tuning in with us today. I know your time is really valuable, so we really appreciate you choosing to spend the time with us. So yeah, again, hope you found that informative. But I think we got to you got to most questions there. But if there are any other further questions, please again reach out to the any member of the commercial team. That I'd be too happy to like I said, drill down to the specifics of whether it be your asset or of course the marketplace that you're in there. So I look forward to seeing you next time in our next market update and event. It's great to see you from Melbourne here, but great to see the Sydney side is back in the office and starting to get out and about. But until next time, stay safe and have a great day. Thanks, everybody.